Good Monday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Parkamonic. How you doing, D?
Hey, Will, how's it going?
Good. You want to start with a disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I at Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your RIA, call your broker. That's what they're there for, to give you advice, provide you with guidance. Let me share my screen. And while I'm doing that, if anybody's joining us for the first time, Will and I, we do these shows in the morning to help answer questions you may have about the Market Chameleon tools, data, or analytics. If you want to come on a show and answer a question live, we provide a link to Zoom on the live chat on YouTube. Click on that. When you get over to Zoom, there's a button, raise your hand. Click on that. Once we let you in, you could ask your question live and direct. If you prefer to type your question, you can put that into the live chat on YouTube. Will's watching it, and he'll read back those questions to me. So while we're waiting for more people to join us and for questions to come in, we'll start out taking a look at the pre-market report. These are stocks trading in pre-market hours. See if we could get some insights. If we don't have any questions, I'm going to default to some of the questions I've been getting over the email, either through the weekend or some of, maybe some of the most common questions I get. We'll review those. All right. So pre-market trading, these are stocks that are currently trading in the pre-market hours. I'm going to come down here and we have three lists. We have a list of our most active stocks in the pre-market, biggest percentage gainers, biggest percentage decliners. And come down here and I see 49 stocks made our percentage gainers list, 30 on the decliners. So from this perspective, we are looking like we're set up for a slightly bullish bias at the open. And if we take a look at this list, we will see that there are a lot of small cap stocks in here. We do have ETFs in there. It could be a leverage product, a closed-end fund, anything that's traded on a major U.S. exchange. If the stock is trading in the pre-market hours and meets our thresholds, it will make this list. And what we want to do is start narrowing down this list to a smaller group of stocks to get a little bit more insights. And to do that, we could use the filters here up top. And this filter here in ETF, I'm going to use that one. Let's click on that. You get a drop down with a menu that you could select different ETFs from. The top one, SPY, that's the S&P 500 ETF. You have some sector ETFs in there. You can filter by your watch list by clicking on there. But let's stay on this in ETF. I'm going to select SPY. I'm going to click on it. The list below will get filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. And here we see 3 stocks made our percentage gainers list, 500 decliners. So not a big list, maybe from this perspective, a little bit bearish bias in the S&P 500. But, I would say probably just neutral there, mixed bag. The only one sticks out, I think, Micron Technology. They kind of had that news over the weekend that China was trying to block, any governments from buying their products. And I think that they got caught up in the politics, right, between China and US. So they're down 4.4%. Let me see. We had like 5 minutes, Will. So if you have any questions, I'll take them now. If not, I'm going to kind of move on.
Nothing popping in there, D.
Okay. So one of the questions I got, I think, over the weekend, we'll go over here, was regarding implied volatility. I'll just use SPY here. I just kind of default to SPY. And the question was, if I wanted to measure implied volatility versus realized volatility, and the theory was that implied volatility tends to overstate realized volatility over the long term consistently. And but how do you measure that? How can you go and find that out? And before I get into the implied volatility, it kind of comes down to another question that I kind of frequently get. So I wanted to address that as well, which is people want to find a strategy that consistently works. So I want to do something that every time I do it, it works and it's profitable. And I want to see that working over a 10-year horizon. And I kind of get that question, it comes up, not everybody, obviously, but I think a lot of people who just kind of get into trading financial assets, risk assets, they start out trying to look for something that just basically, allows them to find a simple strategy. And what they will do is do that simple strategy over and over and over again. And it's going to work every single time. And there's proof of that it's done that same thing for the last 10 years. And I want you guys, if you have to think about this logically now, all right? Think about this logically if that existed. That would have to mean that there's somebody consistently on the other side of that bet that will constantly lose money every time over and over and over again and never adapt. But for the last 10 years, 15 years, 100 years, you'd have to find somebody on the other side of that to consistently do that bet and never change their strategy. On top of that, you'd have to find this working and nobody else has found it, because if other people have found this strategy, it would have just gone down to where there is no real, the profits would have gotten taken away because of the supply and demand, right? There's much more demand to find profitable strategies than unprofitable, right? So you'd have to find something that nobody else kind of sees, and this works, and it's so good, that it works every time, and it works for 10 years, and the people on the other side of this just continuously do the same thing over and over and over. And it's not logical, right? That's not really logical to find something like that. And I'll challenge anybody who does, but it's not really logical to find it, that something consistently works like that, and you're never gonna, you don't have any risk of losses. So that's one thing. The other thing I think people look for is, an arbitrage, right? So like an arbitrage where you put on a riskless or near riskless bet, because you're doing one trade here at one price and offsetting it with another price somewhere else, and essentially it takes away the risk. And as far as arbitrage goes, usually an arbitrage exists because there's an inherent difficulty between markets. Like there's some disconnection or something. Could be a lot of times just on a technical basis, or something exists there that's creating this friction where it's very hard to do something. And usually for an arbitrage to capitalize on it, you would have to have some deep understanding and knowledge and expertise in something. And it usually is a costly setup. Otherwise, everybody would do it. So there's a costly setup. There's time and investment involved in trying to capitalize on an arbitrage, you probably have to have you figured out some kind of angle to capitalize on it as well, because other people haven't. And those arbitrages do not last 10 years, because eventually whatever the friction is there that's creating that arbitrage, usually then other market players and come in and find solutions. So there's never this like where here's an arbitrage and lasts forever, because we've seen arbitrages in our lifetime, in our trading lifetime, and they're always, they're not going to be forever. And the only way to capitalize is that you're creating something in there that's hard for other people to create. Okay. It's probably because you have a special expertise in it, special technical skills, your some kind of special privileges that exist that you could tap into, either through clearing or through being a member of an exchange, or through something in there that would not be available, to a regular person, like sitting at their terminal looking at it. So it's important, because when you're looking at, if that's all you're scanning for, you got to be logical about it. Now I'm going back to the question as well. How do we see if implied volatility, tends to overstate the realized volatility over time? And when we talk about implied vol, I'm actually going to be doing a podcast on this, but when we talk about implied volatility, it's important to understand what is implied volatility? Like, where are we getting this number from? Right? Because it's not like something like a stock where you're trading, right? It doesn't exist out there where here's an implied vol and I could trade it. Implied vol is a derived value. It's an estimate derived from option prices. And when we talk about implied volatility, we tend to reference one number because we try to simplify what is implied volatility. Because if you go to an options chain in SPY, right? Here's SPY options chain. Here are all these different expirations, and you can see all these different expirations have a different implied volatility, right? You could see they're changing. And then when you go and click on an expiration, then you're going to get an options chain. And now you got different calls on different strikes. You have a bid and an offer, you have different puts, and you have different implied vols. And so when we reference implied volatilities, they're number one, they're dynamic, it's changing, prices are changing, and there are many implied volatilities because they're derived from an option price, right? It's an option price that's run through a model to convert it to implied vol. And this implied volatility you could see is different than this one. So it's hard to measure when we say implied volatility. Does it overestimate or underestimate realized volatility? Well, you got lots of implied vols here to test. You could test a lot of them. And when we take one number, a 30-day IV, let's say, this itself is a derived value based on an index, a weighted average of different options that are trying to track what a 30-day constant maturity option that would be right around at the money, right? So the option itself doesn't even really exist because it's not possible to find exactly an option that's always 30 days to maturity and always at the money. They don't exist because they're new expirations and if you list a 30-day expiration, the next date's 29, the next date's 28, 27. So there's no such option that is 30 days to expiration perpetuity, right? The option gets closer to expiration every day. So this itself is an index, a reference point to try to see generalized implied vol. Okay, and you could do 60 days, 90 days, you could do an out of the money option, an out of the money option to the downside, and out of the money option to the upside. So there are a lot of different ways to reference implied volatility, measure implied volatility, and to even trade volatility, implied volatility versus realized volatility. There's no exact science to that either, because on one side you have the implied vols coming from options. The other side you have realized volatility. But how do you trade realized volatility? Because realized volatility, you could, there are different ways to measure it, and there are different ways to trade it, and you're trying to capture the realized volatility by trading it. But that means you're hedging your deltas and your gamma in a way to capitalize on realized volatility. And even that is not an exact science, right? Your results of trading realized volatility are going to be different than my results or somebody else's results, because you're hedging your deltas at different times. You're making those decisions. You have different risk parameters and gamma. So there's no way for two people to trade realized volatility exactly the same all the time, unless they're like synchronized, completely synchronized. And even then, I don't even know, because there would have to be enough stock for both of you at every single point. So all these, when we look at financial data and financial modeling, we really work with estimated values. A lot of time we're looking for things, for estimated values, to say where do we think in general these things are matching up, and how far apart they are. But you will not be able to exactly replicate that, realized volatility versus implied volatility. Just wanted to stress that. Okay. So volatility, it's not exactly like, I bought a stock at this price and I sold in this price at this price, and then I have two reference prices, and now I know what the percent return is. Volatility is the way you're trading the stock as it's fluctuating, at what points and what you're doing, how much delta you're trading, and so forth. So then, can we try to get a sense if the implied vols, if the straddles, right? If the straddles are tended to be overpricing or underpricing vol, right? I'm sorry, if the option prices are tended to overestimate or underestimate, or overstate or underestimate the future volatility. And there are a couple tools we can use to track to give us estimates. And here, if I stick with that SPY, for example, and we have a screener for this, but let's stick with SPY. And I'm looking at the money straddle. So here the idea is the following. If we take SPY and we take the weekly straddle, right? We take the straddle that expires in a week, and we test how that straddle performed. So if the straddle is underestimating volatility, if it's underestimated, it should be profitable, right? In either you hold the straddle or you're rehedging the straddle delta neutral. And if it's way overstating it, then the straddle is going to lose value, because the stock is just not moving enough to justify the cost of that premium. And in here, we could take a look at SPY in a table, and we take the straddle and we look at it from different perspectives. We'll say, okay, let's say we start out the straddle and we started out at 10 a.m. So let the first half hour, the options kind of come in. And if we held it over some time period, how did that straddle perform? And here we could say, we could measure it from Monday to Tuesday, Monday to Wednesday, so we're trying to look at all different combinations, Thursday to Friday, 1 day hold. And we'll say, well,
Bless you.
thank you. Did the straddle tend to overestimate or underestimate, and how frequently and by how much? That's the question, right? So did it overestimate or underestimate? How frequently did it do that? By how much did it do it by? What were the ranges? All this, we want to try to get stats on. And so here we have a week by week, right? And then for those weeks, the week of April 24th, from Monday to Tuesday, how did that straddle perform? And then we see the last 12, and then we get these summary stats here to start helping us out. So here, let's just take from Monday to Tuesday, right? So a new weekly will get listed today. And let's say, from 10 a.m. So see, we'll take a snapshot at 10 a.m. and we'll hold it right up to the close to 3:59. And then we track, well, from this period, from 10 a.m. to 3:59, how did this straddle perform if all you did was, if at the midpoint, if you're able to get it at the midpoint and get out of it at the midpoint at the end of this period, what was the return on that straddle? So you could see here, this is the return for this week. And if you wanted to see the snapshots, you click on view, and this shows you which strike we used, the timestamp. This was the spot price, this was the call price, the put price, the total contract value of the strategy. This is what the straddle was implying, a move of 1.3%. So what happened, by May 16th, the next day, end of day, well, the stock closed at 410.34, so a little bit lower, right? What happened to the options? Well, they came in by $95.50. So that straddle lost 18% on that for this period. Okay. Now, straddles aren't always delta neutral. So we do what if you were delta neutral at the onset, and then we do daily rehedge. So daily rehedge is saying that, okay, if I just did one rehedge, let the stock move, so there is from Monday 10 a.m. to Monday at the close, the stock moves. I have a new delta. I hedge that delta, and then the next day I let it move, and it had another delta at the end of the day. I rehedged that, so I did trade realized vol versus implied, by end of day, but end of day rehedging. So this lost a little bit less, 7.3%. Okay, so trading the realized volatility instead of just letting it go, but by hedging, you lost a little bit less, 7.3% versus 18%. So you could start comparing those metrics. The straddle, just letting it go versus trying to hedge the realized volatility with the stock. So I'm going to come up here, and kind of show these are the stats, and for whatever reason in SPY right now, Fridays are the only ones that I see so far that have shown more instances where, from Thursday to Friday. So the periods from Thursday to Friday showed where, for whatever reason, we'll have to go look at the data. Maybe the implied vol's fallen on Thursdays to very low levels, or people who hold straddles start to sell them, around Thursdays, or there could be more volatility between Thursday and Friday. But for whatever reason, that one stands out as the period where the straddles were profitable more often than not. Right. So we see here, that the profitabilities range, as low as 25%, high as 45%. But on average, they were losers. There are obviously weeks that they gained, but on average, they were losers. The only one that really stands out here so far is from Thursday to Friday. So this kind of points us to the data is now pointing us to something to look at. Well, why is that happening? So we would have to do more deeper analysis and say, let's go, and then we'd have to go into the data and look at, well, are the straddles on Thursdays, were the implied vols in those straddles, is it the options underpricing it, or is it the stock tend to move more, or a combination? Were there news between Thursday and Friday? We had earnings, but what's causing that? And that's where we start trying to dig deeper into the data analysis and see what type of opportunities we could find.
Hey, Dave, Robert just asked Dimitri, is that because the straddle assumes it closes both sides simultaneously?
Well, yeah, in each of these cases, yes. So the straddle will be, the straddle is the strategy of both sides each time. If you break it up, it's no longer a straddle. So it assumes that, yes, if you bought it simultaneously, and then you closed out of it simultaneously. So it assumes that it's the straddle itself is always both sides simultaneously. So, and what this table does kind of gives us a distribution of returns over different time horizons of how these straddles performed. And we could see, even the, how high, so some of them, we could see here, some of these straddles, especially from Thursday to Friday, more than doubled. So you had 1, 2, 3 instances in the last, I think this is like 12 weeks, something like that, that the straddle more than doubled between that period. All right. Here you got 189%, got 150%, 167%. But there are instances, you lost almost, 90%. So you could see the ranges of returns in these straddles. You could, so these are risky, they're volatile, but you get a sense of, how often these straddles turn out to be profitable, unprofitable, and what type of ranges are we looking at. So we're right up at 9:30, Will. I was going to go to the screener to show you where to kind of measure these as well, but I don't think we'll have.
Why don't we go there tomorrow?
Okay. All right. Perfect. So, yep. Everyone, thank you for joining. Stay safe out there. Have a great trading day, and I hope to see you guys tomorrow.
Yeah, remember, some thumbs up on the way out. Thanks. That's always appreciated. Great job, D. Great job, Chameleons, for joining today and the questions. Have a great trading day.